So, day-by-day method to debriefing. This moves away from the sort of developing specific strategy, setup, playbook orientation of debriefing, and more looks at things from piecing an entire story together of what has been going on recently, so that what you're effectively doing is, rather than looking for specific moments and specific things, you can still do that, and that generates the ability to act. What this does is it generates a story. It allows you to see wider patterns, wider structures over time. So the way that you want to be doing this is about bringing it onto perhaps only your main market, focusing on that and looking at how the day has played out as a whole, the journey that the day has taken, the structure of the day type, where the action happened on the day, how the market got itself positioned, how the market then changed its order flow, the way it traded as a whole. This gives you a more rounded understanding of what is going on for a wider perspective, and then enhances your ability to know what strategies to use in what situation, from which you can pull those out of your playbook. So it kind of has a two-way aspect. The day-to-day will identify specific opportunities, which you can then deeply review for a playbook. Equally, the playbook then provides skill sets to apply on certain days, and it gives you that ability to go, I could use that here, I could do that here. The good thing about a day-by-day method is this gives you a direct comparison to your prep. You've done your prep in the morning, you've done your hypothesis in the morning, so you know what you're looking for on the day. This gives you then the ability to go and ask yourself, well, what did happen? Were the reference points that you looked at ones that worked? Did things happen where you expected? How has the structure changed from what you were looking at in the morning? What this allows you to do then is pick apart your analysis from the morning, pick apart the ideas that you've had, and to understand where those ideas can be improved. Are you missing something in your analysis? Did you not expect something? And can you now identify where that came from and how perhaps you could expect that in future? So what it's doing basically is taking your preparation process, which is very clear, and then asking, does each of that preparation process make sense? Because then you can slot in new extra questions into your prep. So it's all about this kind of constant feedback loop that you're trying to generate. What it also does is it makes your prep the following day so much easier, because now you come in the next day and you've done a huge amount of it. You know the significant points that traded. You know what happened at those points. Rather than looking back at what happened and sort of thinking, I wonder if we saw absorption there before the level break, or if the level went straight through, all of those things, you know how the market traded at certain points in the day. So it makes your debriefing more efficient, because it's a comparison of information that you understand, and it makes your preparation much easier. This is how people can prepare quickly, because they've got all the answers. And so your preparation is then just recalling those answers and then putting them into a element of, right, I know this, what's the implication of that going forward? And this way you generate this sort of constant rolling story of information. One of the key things that you need to be doing is making sure that you're, like your prep, putting comparable things into it. By doing that, you can create new ideas. You can say, right, well, I'm looking for this, and comparing those, and you start to see new things coming through. If you don't have facts, all you're working with is an opinion. You're working with your opinion as to why something happened. You don't need to do that. You don't need to know why something happened, because you may never know the answer. And that's an important thing to remember. Some things you won't know the answer to, and you cannot find the answer to. So don't worry about them. But what you can do is you can know what happened as that unexplained event happened. Market goes from very, very balanced and then trades down. You may never know why it did that, what the cause was, if any. But you will know what it looked like. And so then if you see that again in future, you know how to then trade it. And you could call it trade an unexplained move. You don't know what the move is, but you know what the order flow looks like on these odd moves, and suddenly they're not odd anymore. So what you're then trying to do is use this then to lead you towards a weekend review, where you can review each day and assess, well, what happened on each day? What ideas can I draw from this? So again, it's an idea collection method, so that your weekend reviews really give as much as they can in terms of new ideas. You're not trying to develop new ideas today to use tomorrow. You're trying to develop new ideas over time that then are going to help you in future. One of the other key aspects of this, and to make your life easier in going back and finding similar structures, similar type of scenarios, is branding your days, giving them a name. And it may sound really simple, and this doesn't have to be massively innovative. You're not trying to sell the note of the day, What you're trying to do is just give it a title so that you know what happened. You can very quickly, oh yeah, I remember that. I remember how that played out. And you'd be amazed that just by giving something a title, you very quickly know what it was, when it was. You know, some days like Pfizer Day, for example, that I know a lot of people have got written in their debrief from the 9th of November 2020, everyone remembers that. Of course, it was a very big day, but it's referred to as Pfizer Day. And you know exactly what that day was. You know what happened on that day. The Fed forced 75 basis point rate hike. Again, you know when that was. That was the June Fed in 2022. There's all sorts of events that people can reel off and remember because they've given their notes a title. It's not that they've got any special memory. It's just that they've created a way of remembering these things and recalling that event and that action for themselves. So it's creating that association to a certain move, a certain event, a certain action. One of the ways that you want to do this, again, is give yourself metrics to look for. And I'll give you a kind of checklist, a basic debrief template in a little while of things that you should be bringing into your debrief. Information you should be rolling in, ways of comparison. That's the key to it. But give your day a title. Makes it simple to remember. And this is just a brief description of the action. Take here, for example, this is no special day. This is just day picked to illustrate this. Wednesday, post payrolls. So middle of the week after payrolls, obviously it's Wednesday. Post payrolls, head and shoulder failed to break. So this was head and shoulders pattern across all US bonds that was generated on the back of the payrolls move. You get a big sell-off on payrolls, creating this situation here. So you get the payrolls jump, head and shoulders, and then you're looking for this move down. And this is there across all bonds. So the play then is, well, the head and shoulders pattern. What happens? And this is only the top of the debrief. There's more to this further down. But this then gives you the structure, gives you the idea. And now you can think, oh, I know, I remember what happened. And I remember distinctly what happened here. The play was to look for the head and shoulders break. Now, the 2-year bond hit the neckline, whilst the 30-year bond hadn't. So that's the 30-year bond neckline. There's your 2-year bond neckline. So looking at this, in fact, I think it was actually the 10 rather than the 30. But with each of them, there's your 10 and there's your 30 downward sloping necklines. They weren't at it when the 2-year gets there. So whilst you're looking for the 2-year to go, with the others not breaking, and the highlight here being the point that the 2-year hits the neckline, with the others not breaking, the move doesn't happen. And they pull the 2-year up. The memory of that is very clear. I know what it looked like. I know how it felt looking at that trade. Because I can look back at, oh yeah, I remember that. I know exactly what happened on that day. So that's the value of giving it a title, giving it a branding. And so then this becomes an idea where you start thinking about the correlation between different markets. The 2 years were strongest going into this. So if anything, the 2 years were the one that were going to bounce. That was the market that probably wasn't going to break. And yet when the 2 year gets to the point of break, it's the longer end that holds it up. So essentially this was a trade where the strongest market was held up by the weaker ones, i.e. if the weakest markets won't go down, the strongest one isn't going to go down. And so it illustrates a time where you don't want to be playing this as a break because of the correlation with other markets. So it helps create that memory and that kind of idea of how to look at these types of trades. This is something that I've been investigating myself on how do you play certain spread trades using an outright trader's perspective of things. But in terms of metrics, I think this is really important to make your days comparable and to be able to give your day context. So you go, right, well, that day similar to that day. That day similar to that day. Looking at, and the things that I've always used are themes. Has this been a news-driven day? You know, what news has happened? There'll be some days where there is no news, and you can write nothing of note. Maybe it's earnings season. Maybe it's a day with multiple central bank speakers and data points. Maybe it is a central bank after another central bank, and you often see this where you get the Fed, the ECB and payrolls day after day. Typically in February and May is when those things happen. Again, you know that just from having noted these things down multiple times. So you can find other past examples of where you have that same sequence of days. Correlation. Look at what's influencing current trade. There have been periods that I have seen where bonds, equities, gold, dollar all move together, or almost conversely to the dollar. So the dollar strength, equities fall, bonds fall, gold falls. There's been time when these are completely divergent. So you then try and pick up on the different correlations that go on. Are we in a dollar-driven move? Are we in a risk-driven move? Are we in inflation-driven, stagflation-driven? Are we in a completely independent market type? So by looking at those correlations, just noting how different things have interacted with each other, again, you give yourself that sense of similarity. You will recognize other days that you've written similar things, where perhaps European equities and US equities do not correlate. One goes down, one goes up. Or European equities fall and the S&P won't drop. Things like that. And you'll be able to think, okay, well, how do I trade these situations in future? So you're giving yourself markers, really. You're giving yourself reference points. And I know that this perhaps doesn't sound easy in terms of being able to say, well, that's going to give me this and this and this. What you're doing is by increasing the amount of information that you absorb, you're giving yourself the ability to then work through that over time. Some things will not become clear immediately. Some things may take a long time to become clear. But by having gone through the effort of just marking these things down, if a pattern starts to emerge, you're ready, you know it. And chances are you could also pinpoint roughly the day that that may well have happened. So that's the idea behind these types of things. Volatility as well. Just a rough gauge of volatility. Is it increasing? Is it decreasing? And I'll talk about this more when we look at strategy development and trying to match ideas over time to actually have a very rigid kind of assessment of volatility shifting over time. But a generalized description of volatility, again, puts things in perspective. If volatility is falling, is the move that you've seen on the current day reasonable? Is that what you should be expecting? If volatility is rising, equally, is that something that you should be expecting? Categorize things into environments. What type of environment are you in? Obviously, volatility plays into this quite well, but this is a more broad generalization. Are you in high volatility markets? Are you in high correlation markets? What is the correlation, if any? You could even do this and color your title to make these things easier to kind of work through. And what you'll probably find is that over time you'll have a sequence of similar colors that then deviates into a sequence of other colors. You may well see pattern that all of your green titles, which are in high correlation environments, say, then shift into independent state environments, theme-driven environments, technical-driven environments. So by, again, making it visually easier and making it quicker to go, okay, I know this, I remember this, and you can recognize things as time goes by, make your life a lot easier to go back and find similar situations. You know, one of the keys to doing this on a day-by-day basis is you will do your prep and you'll think, I've seen something like this before. You can then whiz back through some debriefs and you'll probably be able to quite quickly find a very similar situation. That gives you a template then as to how the day quite possibly is likely to play out. You've now got so much more confidence in what's going to go on because you've seen this before, and you can at least go, well, there's my template. This is roughly what should happen. Is it doing it? Is it playing out in a similar way? So that's the idea of branding things, of having clear metrics as to what you're looking for or what you're comparing on each day. Make it easier to go back. Make it easier to recall things. Right, annotation is really important. One of the best ways to organize your ideas, because whilst that's giving you a framework and some of the things you should be thinking about, annotating your charts pinpoints what stuff looks like when certain things happen, quite simply. Now, I've got a few different variations. This is a sort of day-by-day annotation, so the kind of thing that you might do approaching the end of the week or after a sequence of days. What you're looking for here then is to try and just identify where things happen, where things changed. For example, pit session liquidations. What happened there? This is clearly a middle of the night drop and reverse. So what's this pit session liquidation look like? Over time, you're going to need less and less annotated, written down information. With experience, pit session liquidation, in my head, I know exactly what I'm thinking now. I know what this should look like. So I don't need lots and lots of description and information. But at the start, you do. You need to get more and more of that information down. So then you get a consolidation after this liquidation day. There's your B-shaped liquidation, consolidation day. This would be something that you're expecting. And again, by going through these things, go, right, what happened on this day and this day and this day, you then very quickly draw these conclusions. You think, yeah, consolidation looks pretty reasonable. I could expect that. But getting information like this, that the lack of energy on the break of lows matters, because that's telling you something about the way the market's trading down. Having done this, today as I was talking, a thing that I saw in the Bund was a situation where the market drops down into a lot of volume and it just will not pick up any pace to the downside. It's constantly pushed back. And that's information because that then tells you how the market is trading today and how it may well change the next day. And it's those little captures of information that are going to help your planning going forward, and help you better recognize what it looks like when that happens. They're frustrating days for me. I look at that and I'm like, but it should go, and you feel that tension where you think it should go and it won't go. That's something that you can then bring in going forward. You know what it feels like. Again, pit session, runs out of energy onto the lows, and then you get this late counter move, this late liquidation. So what you're trying to do is understand how it's moved at different points, so you've got a better understanding of how it's likely to do this in future. Typical expectations that you can now start to build up post a liquidation day. So it's been generally building up expectations going forward. It gives you this late counter move. That may be surprising, but if you've seen some of these types of things where you get a liquidation, a failure to push lower, this is part of the concept behind a 2-day reversal trade, that you get the move and then you get a market that just doesn't build the energy to keep going, then you get this quick reversal. That's a way of trying to look at these things. So the ideas then start to come through and you start to see similar situations where these types of things play out. You can do move-specific annotation. What happened within a move? And one of the ways that I would do this, and I think it's a good way of judging any kind of movement, make sure you've got something to give you context. Because if you just look at this on its own, it's a 5-minute chart, it's a 5-minute chart. Without any context, it's not clear whether this is a move that you really should be believing is going to keep going. For all you know, this is just a drop within a range, and we're going to rotate back up. You don't know that. But once you give yourself some context, you see that actually this is part of a much larger move. This is now this move. Now you can look at it and go, okay, right, well on these big trending moves into a gap, what happens? Where's the pace? Where's the steadiness? How do you play these types of moves? How have you then got to generate trades? This is your classic breakout smoking chimney move, which now puts the onus on. It allows you to then think, right, well, next time, the onus is on me getting in here and being aware of the potential for this. Because the hardest thing to do in here, and part of the write-up that I put on this, is keep looking for shorts until the trend breaks, and particularly after a false break. It's better to remain bearish than picking up small winners to the upside. And this is because of the fact that you're assessing the wider perspective and then putting the detail on the shorter time frame chart. The detail helps you then understand the way that things trade, the nature of these types of moves, what makes that difficult to trade, because they are, and how you then need to adapt and deal with that. And one way to deal with it could well be to say to yourself, right, I can keep looking for shorts, but accept that you may not get an opportunity. You may have to wait quite some time to give yourself a clear breakout chance to then play this move. But if you've got that ability to go, right, I've seen this type of movement before, the generalized move, then you can know that there will be another chance. And it allows you to then observe it, let the move happen, in that knowledge that at some point you'll get that chance. You don't know when it's going to come, but that's okay, because you know you're going to get it, and it allows you to wait for that and be more committed when that chance does come around. This is then a variation. This is one of our other traders. And one of the ways that people do it, and I'll talk about the power of writing in a little bit, is to actually do this by way of using one of those little pens on an iPad. The reason for that is physically writing, you remember stuff better. There's proof of this, there's all sorts of research, go and have a read about it, I'll talk it through in a little bit. But by doing that, then you're getting a better understanding of what's going on. And this is an example, this is what I call sort of identification. And what he's identifying here is zone between upper and lower balances, and this is a critical point of failure. So the idea being then that this is where your decisions are going to happen. That's where you need to have a plan. So you get what he's called a fragmentation / FOMC block. So a kind of a block, but one that's somewhat scrappy, compared to this very clear positioning down here. And then what happens? And it's almost in this one, talking through the mindset and the way to think about these different things. So point of failure comes point of acceptance. This is not a bullish auction. So it's a bit the ability to go, right, well, when it gets in here and it accepts in here, straight away, this isn't bullish. You now have a play. And you then put market shouldn't be back at this point of positioning if it's so strong. And that's a really powerful thing, that kind of concept of saying, well, a market shouldn't do this. And it's not to say, oh, the market's wrong, it shouldn't be doing this. What it's saying is, if this is a strong market, coming back here negates that strength. It tells you that actually it's not very strong. So this is an identification point that goes, right, when you get back here, if this doesn't bounce away, any strength that was perceived is surely gone. All of these people up here now are in trouble because the market, given the chance to prove its strength, where you would expect buyers to appear and counter a move back into this block, they don't. So when that happens and they accept down here, now you know you've got to play. So it's that sort of identifying those little changing points, what happens, how to think about these things, and how that thought process then gives you a trade. You know, this concept of it shouldn't be back here if it's so strong tells you everything you need to know. That tells you that, right, we're back there. I know what I need to do now. I know how I can play that. And so then this relates back to your game plan and your access to the trade. You see that it's accepting down here. Your thought process then immediately goes to, right, you've got this very clear little block here. We can trade straight through that. There's your play. So it's identifying those plays as the day's gone on. This is one then looking at the sequence of days. So this was then going into the Fed, the day into it, the day of it, the day after of it, the day after it. And so what you're looking at then is a description of each different day. So you're getting to see this kind of rather odd sequence of days where you have big sell-off, big reversal, big sell-off. Not a common sequence of things to happen. And so then going through, well, what has happened here? So description, reality markets auctioning with extremely volatile and balanced range, which absolutely, it is in a range, it's just extremely volatile. It is whipping up and down, up and down, up and down. And that's, for anybody wondering, 300 tick range in Bund. That's huge on a daily basis. So it's trading back through the midpoint point of control of volatile balance is actually the most vulnerable point of the balance. So again, changing that idea of trading around the middle of a range, when it's particularly volatile, that becomes a kind of tipping point that the market will rip through it one way then the other. Identification of an easy way of kind of oversimplistic analysis. It's easy to assign this as Marabuzzo's strength. Now, on an individual day, a very strong move up like that, absolutely, you could look at that and go, that looks really strong. But in the wider context of this is just reversing what is already a very strong move to the downside, negates that and illustrates further that this is just whipping up and down, which then gives you confidence. Sweeping through the middle of balance was the fastest part of the offer. Again, it's just picking up those bits of information so that next time you get something like this, which you will, there will be a situation where you get this big sell-off at the end of what is already a rather big sell-off, followed by a very fast reversal, followed by a very fast reversal, then actually you find there is not much time spent in the middle. And a market that kind of rips across the middle of a range. Not typical, but when you see these types of situations again, you then may well be able to go, okay, whip down, whip back up. If this starts to drop again, the market's got no confidence down here, but it's got a lot of pace, a lot of volatility, a lot of volume, it can still go. And it can go through that range again. That's the information you're trying to take from this. So looking at that wider move. And I'm sure now, having seen this, there are going to be some of you that will think back to this and you'll remember this if you see it again. The little orange, blue, white pattern, if you will, there. You'll see this again and you'll think, yep, I know what I'm looking for here. And it's not to say that will happen. But what you're doing is you're creating the ability to go, well, if it starts to happen, if it looks like it's happening, I know exactly what I'm going to do. I know how I'm going to take this trade on. Excuse me. I know what I'm looking for, and I know how I'm going to be aggressive about taking it on. The other thing is trying to take the nature of the move. So how the market is moving. I'm not going to go through every bit of annotation here, but just, and it can feel like you're repeating yourself because you will have looked at this day when it was this day. So you can put in a little bit more of a summary. But again, by annotating day by day what's happened recently, you keep yourself in line with what's happened, on track of the overall story. And of course, you're not going to continually go back and rewrite the story again and again and again. But it just keeps your mind there that, you know, you do still have a gap out of a range. That creating a liquidation move. The final liquidation with then a very, very weak close. All of those little bits of information. A market that clearly after this big liquidation, then weak close, doesn't know what to do. So does a move like this often generate a poor value area type day where nobody's really sure where to go and what to do. So you end up with this wide, fast balancing range. All of those bits of information start to pull together. It one means that on the back of something like this, you may well be better at recognizing the possibility of something like this. It means that when this starts to happen, it's not a surprise. It's not that common to see days that start off very aggressive to the downside, then steadily back up, then back down and back up, wide ranging throughout the day. But perhaps this is something then that you go, okay, well, this does happen when clearly we have a market that showed a pretty strong idea and then gave it up at the top. And it's that push-pull now here between value attracting back up versus the fact that value is only up there because of a liquidation. Looking at the way it traded out of this zone, this was, think back to the reversal trade, that ledge break, late drop. This was that. Different market. That one was the pound, this one's the bund. But we create a ledge, the market holds and holds and holds, and then as soon as you get past the close, drops. So you get this late, just roll over down the range. So effectively, this is the market that never wanted it to be up there, it just got held up there, and then it rolls itself over. This is perhaps primed to at least test back up here then. So you then start to think, right, I've seen these types of things before. I can now be expecting that at some point we're going to get moved back here, and then I can look to see if that passive buying that held us up is still there, or whether we just get there and sellers come straight back and send the market back down. So you've got a very clear reference where you're expecting to see action. So by detailing all of those things, then you start to get a better association, a better plan forward of, right, well, I know what happened, now I can say, oh, I think I can look for these things the next day. You're generating a story over time. This then is there to help you the next day, the next day, the next day, 2 months down the line when you see something similar to this in the future. The next day then, you get that trade. It's almost to the tick. You trade up, you hit the VPOG, market rolls back down. It's almost to the tick trade. But you can expect that. You're looking for that. And as long as the market doesn't fly up there and stay there, that's a play. So you get that as a play back to the top of the range, back to the top of the IB. So this whole zone here, 20 down to 08. That's the first trade. That's a 30 tick move. Nice quick little trade. You also know that there's this poor value area below you. At some point that could happen. And that then becomes a trade that you don't get to play straight away. It's one that does take its time to get there. But you still get this kind of strange pennant type situation. But you know that throughout that poor value area still needs filling in. And having the patience to then wait and go, well, I know that this is there. I don't have anything else to do, because you understand what's happened previously. This is where the market is clearly uncertain. You don't get involved. But when you fall out of that, you know that poor value area can be there to fill, down to here. Tough fade. That's why I got written there. It's not an obvious access on that one. If you're looking for anything, you at least want to see the bottom of the range. You don't get there. By that point, you are below value. You're almost on this ledge. So there's a reason to think we might go lower, which it doesn't do. So that stops you buying it. There's not really a reason to buy it because you don't go far enough to want to buy it. That looks like a nice trade. Just play it back up. But it never gives you a reason to really believe that. So it's by going through these things, you're highlighting where you've got viable opportunities and where you don't. That then draws your day together, draws the story of the day together, and one, makes it much easier to remember. Two, identifies things going forward, looking for tomorrow. This then is still an untraded ledge. This is still an opportunity for another sell-off the next day. So it allows you to and enables you to think forward much, much easier. So far on the day-by-day stuff, we've looked at the technical aspect of things, picking up the story of the day. We've also talked about annotation. Now, one of the things that really gets that into your head and gets you to remember things better, understand the answers that or the conclusions that you've come to better, is writing things down. And what I mean by writing things down, physically writing things down. There's a lot of research to suggest that this does improve your ability of understanding and remembering what's happened. And so one of the things that a lot of people will do, I still do this, I will write down what's going on, my notes for the day, on a sheet of paper. I won't type it up, write it down on the sheet of paper. These scribbles you can then type up if you want to make them a little bit more structured, which again reinforces the learning, because what you're doing is you're taking a step back, rereading it, digesting it, and then getting it down with a little bit more clarity. But your assessment of the sort of psychological aspects and the way that you've traded and what you've done on the day ideally should be done in pen, pencil, whatever you want. But write these things down. If you type stuff, it's distance. Think about what happens when you type something. You press a button. Now those buttons are indistinguishable. Of course, you know where the buttons are on a keyboard, but the difference between an A and an R and a D and an X and a whatever other button is not there. There's no difference at all. Whereas when you write a word, there's a structure to it. there is a way to form each letter, and that physical side of it, as well as the mental writing the words down, means that you get these things down more clearly and you remember writing those things down. The other aspect is, when you're typing, because you're thinking about the next letter and not the whole word, it's easy to type more than you need to. A lot of people nowadays are faster at typing than they are at writing, so they become inefficient. You just type and type and type and type, lots and lots and lots of words, but without really forming a reasoning behind things. It's just easy to sort of blurt out information. Whereas if you write, it slows you down, it makes you more considered, and you will actually get down things more definitively, more clearly if you write them down. So, what should you be writing down? The stuff that you should be writing down really is about questioning what you've done on the day, your process with which you've traded. And so it's creating this kind of questioning process, questioning the things you did, why you did them, and writing down answers to these things. So looking at things like where you're making money. This comes back to the original couple of ideas of noting down each individual trade. But just by noting down where you're making money and describing what you're doing, again, clarifies what it is that you're doing well. Where you're losing money, is it the types of trades that you're taking? Is it the day type that you're trading and you're misinterpreting the information? Is it the fact that actually the reason that you lose on a lot of trades is in your head? What I mean by that is, are you generally losing when you become frustrated? Are you losing after losing on your first trade? Are you losing when you're reaching the upper side of what your expectation is for the day and you're starting to limit your performance? What is it that generates losing trades? That way, again, you're now starting to investigate these things more by asking yourself why, what happened. That way, you start to understand the mistakes that you make, you understand how you can prepare better, how you can execute better, how you can debrief better. Don't forget, though, to write down what you're doing well. It's something that individuals are very bad at. Most people are quite modest and they see it as arrogant to say, oh, I'm good at that. And people don't like to do it. But do it. This is a personal thing. Write it down. If you've done something well on that day, write down, I absolutely nailed that. I came up with an idea, it was a brilliant idea, and I smashed it. Because that creates confidence. It creates a momentum of belief in what you're doing. It's not to over-egg the point and sort of, create false confidence and hope, but it's to be able to say, do you know what? That was a good idea. I recognized the idea. I questioned the idea as it was happening. I planned what I was going to do. I executed it how I wanted to, and I ran it to the target as I intended. That was a brilliant trade. And don't be modest about it. If you've done something well, be proud of it. Be willing to tell people, do you know what? I am good at these types of trades. I can nail a breakout trade. What you're doing there is you're basically saying to yourself, next time this happens, I've got this. I know what I'm going to do. And you feel good about it. It gets rid of that hesitation. The next time you go, well, was I a bit lucky? Did I just happen to run that perfectly last time? No. If you did it well, if you planned it and you did what you planned, you got exactly what you wanted. And that's a perfect trade, or as good as perfect as you can get. Perfect's not about selling the high and buying the low. Perfect is about being able to say, that's what I intended to do and I did exactly that. You can't do much better than that. I'll talk about this in a moment. Getting down what I would call your tilt. Why are you getting frustrated? What is it that's creating difficulties in certain circumstances? When are you not maximizing trades? Why don't you maximize certain trades? And asking yourself honest questions. Why are you not sticking to your process? Why is it that you're jumping into trades early in the morning? What's going on? But you have to be really honest about this. Give an honest assessment, and then, and this is what I'll show you in a moment, provide yourself with answers to the things that you pointed out. Because if you don't do that, all you're doing is identifying things. Oh, I did this badly, didn't execute that trade very well, chased something here, and identifying stuff fine, but it doesn't solve a problem. So then give yourself answers as to why you did it and what you're going to do about it. Always think in terms of action, not just information. Information is great, but you have to convert this into action. It's not good enough to just build up a plethora or an inventory of information. You need to turn that into something, turn that into some action. The other thing that you want to try and do, this is part of having a growth mindset, is create winnable games. Write these things down. One of the games that I know one of our top traders has used for a long time is what he calls sloppy trades. When you go through a period that you see that you are making mistakes and you're doing the wrong things, he keeps a sloppy trade tracker, which is quite simply every trade that you enter and you think, that wasn't a great idea, and you know what a sloppy trade is. If you don't know what a sloppy trade is, you haven't taken one, so you do know because everyone's done it. The kind of trades where you think, I'm not sure why I'm in this trade, I don't know where my stop is, I don't know where my target is, I don't really know what's going on, but I'm in. Any of those things are a sloppy trade. Create a tally. Next day, reduce it. It's a winnable game. You can get less the following day, and you get 5, then you get 4, then you get 3, and then when you get 0 one day, well, guess what? You've got to stay there now. So it creates this constant game. You can constantly improve without having a finite conclusion. This keeps you growing, this keeps you trying to improve. It makes sure that, well, you don't want to drop the ball now. You got to a point where you made no sloppy trades on a day, you sure as hell don't want to be making a sloppy trade tomorrow and spoiling that run. And so then you can turn it the other way and create a run of days without any sloppy trades. That's the goal. And if you create a run of trades with no sloppy trades, the run of days with no sloppy trades, guess what? You get that to 15 and you put in a sloppy trade. Now you've got a benchmark, now you've got a target. It's always about doing things that you can constantly try and beat, constantly try and better. So, debrief of thinking on the day. So this is just a generalized overview of the day. You're not trying to describe what happened specifically, but what you're trying to do is you're identifying thought processes. Here, this is a trader who's quite clear on what his principal ideas are on how he trades. So he's got Euro trade this morning, was not related to principles. The first sign of peak bullet quality is creeping into my decision making. Now again, he knows what he means by this. The idea of peak bullet qualities is likely to relate to the idea of just wanting to shoot at the first thing you see. And so how does this play out? Attaching yourself to a fast, direct piece of information, willing to double click on an unquestioned idea. No prep took place leading into the market interaction. So this is then an identification of what happens when you jump into certain trades. So this trade here, what happened within that trade? What was the thought process behind it? What went on? And so then you can have an assessment of it, a description of why. Non-process aligned window of trading can still produce results in the immediate term. That's the temptation. It's identifying these types of things. Pointing out to yourself that that's why you're doing it, because you can jump into something and you will get results. This could be a winning trade, but it's not aligned with process. There's an eventual cost to such behavior in the form of drawdown, whether it's process, equity, or both that suffer, it will eventually take hold. It's basically saying that, it's reminding yourself, this is a trader who's been trading for some time, and you would think he doesn't need reminding. But the point is that if you're doing these things, you do remind yourself. This isn't a job of a teacher marking your work. You don't have to show this to anybody else. But by reminding yourself of these things, you give yourself that ability to go, right, I know how to stop this. I can see the mistakes that I'm making and see the eventual cost of these. This is one of the first steps of entering a process drawdown, is to begin seeing what market information as a constant stream of process-related information that needs to be acted upon. So all of this is about then looking at what you've done on the day, providing yourself solutions, providing yourself a way of reframing the thinking, conscious of your thinking, being aware that something needs to change. Use logic to challenge thoughts. It's about slowing yourself down. This idea of using logic to challenge thoughts comes back to that whole idea of, well, if you've got a trade idea, you can't just jump straight into it, which is exactly what's happened up here. And by writing these things down, that just short debrief for the day, it doesn't have to be massively long. You've got all the information you need. You can recall this now and you can see the mistakes that may well get made. And what you're doing there is you're pushing yourself away from that temptation and what is likely to turn into an eventual drawdown. And like I said, I quite like the assessment of the idea of a drawdown of process or equity. Losing process is as much of a drawdown as it is losing money. If you deviate from your process and you move away from that, eventually the equity will fall as well, because you're not doing the things that have got you to where you are. So seeing a drawdown in process, sloppy preparation, not preparing, not planning trades, talking through the trade as it happens, all of those things are what create a drawdown in process, and what that leads to is an eventual drawdown in equity. So think about things in terms of action. Like this here, it's about finding ways to deal with this. How to change your future actions. You can't change what's just happened. You're not going to make this trade better by thinking about it, better by writing it down. Whether this trade's a winner or a loser, the biggest thing to be assessing is your process, and that's the point of writing these types of things down. If this trade's worked out wonderfully, that's great. And you can sit there and think, well, I've got myself a little bit of money. But at what cost? It's a mistake that people make, that they get drawn into, well, that works, and just keep on shooting at stuff. But if it didn't really have too much plan, the biggest process drawdown of not having a plan, not having a real clear idea of where you're making money, is that you're never going to replicate this because you don't know what it is you're trying to replicate. That's vital. And so by writing these things down, you then start to recognize that. So remember, you can't change what's happened, you can learn from it. Even if it's a good trade, you can learn from it because you can look at the way you did it and how you did it. There's an example here then of looking at your thinking on the day. So rather than just annotation of where the market was, what happened, how it moved, this is then looking at your thought process within the day. So process aligned idea, clear path to the move. Self-management and timing was different between outperforming and underperforming. So the point being made here is that whilst the idea is good, the lack of management, the lack of timing is what's essentially caused the problem. Strategy versus tactics, subpar tactics kills strategy in here. The whole idea of strategy versus tactics is that a strategy essentially is something you've learned, playbook. You go, right, this situation, I do this. So this is going to be a move through some relatively poor highs. You can see exactly what the idea is. You can see the play here that you come back into this range and accelerate higher. That's the play. But because you've got that, you know what you're looking for, you know what the play is. You then superimpose a strategy on this. You go, right, here's the strategy, I'm going to do this. I know what's going to happen. Gap down, we're going to position in here, and boom, off it goes. Just by applying a strategy over the top, you're not dealing with the way the market is actually trading today. What is really happening? How is it trading? That's what tactics are all about. So it's about taking account of the actual situation. You know, think of it as a game of sport. You can come into any sports match with certain strategies. If you can do this, 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 this. But the other team is going to do something else, and you have to adapt those strategies. You need tactics that shift around. So it's all well and good to understand what should happen, how it should happen, but the when and the how is it playing out right now. And this again relates back to game planning. How it's playing out right now is crucial. And that's the bit that he's getting at here. So whilst it's not massively detailed in the debrief, or massively detailed in this annotation, it's just illustrating what needs to happen. You always take it back to, well, what needs to happen? How are you going to deal with this? What are you going to do about it? That the focus next time is very much going to be much more around the tactics of how you're doing this. Reliance just on strategy is not enough. That will get you so far. The tactics are what's going to make you better. If you want a more structured version, this is a different trader's variation of it. But, you know, it's something that I'll give you a little checklist of things that you can bring into a debrief. More structured version of this is to go through where you lost money, why you lost money. Equally, where you made money, why you made money. Don't just make it to lost. This is quite telling from this trader that he's somebody who leans towards the negative sides of things and always looks at how do you improve things you're doing badly rather than look at how can I leverage things I'm doing well. So I changed this to where you lost or made money, why you lost or made money, an explanation of those things. The problem with only focusing on losses is that what you're doing is you are always leaning yourself towards fault. And it's not to say, oh, just positive thinking will make you a good trader. It won't. But by focusing on faults, mistakes, losses all the time, what you do is you pull yourself down. You suck yourself into always thinking about how to avoid that, how to not lose, which is not the mindset that's going to allow you to leverage trades up and drive yourself forward. Instead, what it does is it brings you into a very defensive mindset. So make sure you're also looking at where you are making money. Again, highlighting improvements and things that you've done well. Things done well, very brief. Improvements, not so. One thing that I would suggest in a debrief when you're writing these things down is clearly, I'm going to predict just very simply from looking at this, that this was not a great day. Spend much more time looking at improvements rather than what's done well. On the bad days, look at what you've done well as well and focus on that. Try and draw out what you have done well. It's going to be a rare day that you have literally done nothing good at all day. That's not going to be common. So focus on those things that you have done well. As well, of course, there are improvements to be made. If you've had a down day, you're going to have to go back through those trades and look at what happened. But make sure you're also picking up some of the things that you did well. One thing that I would say in terms of improvement here, simple instructions are not necessarily going to help. Stop being frustrated and getting angry. Everyone would like to do that, but you've then got to, and it goes on, remain positive throughout the day. It's great to remain positive. Okay, so how are you going to do that? What is it that you can do? For me, one of the ways that I've always tried to, prevent frustration and prevent anger on a losing trade, and even a winning trade. Sometimes I get quite frustrated with winning trades, right? The trade works and you know that you've got out of this too early. They're equally frustrating. For me, one of the ways to deal with that is always to come back. The moment I'm out of a trade is to ask myself, what have I learned about where the market wants to go? Nothing to do with your trade. This isn't the job of debriefing your trade. But what it does, it keeps you on an even keel of not getting overly frustrated by the result of that last trade. That's gone now. We'll leave that to the debrief later. If you ask yourself, what information have I learned about what the market wants to do? You put yourself back into the state of looking for new opportunities. It doesn't mean you remain eternally positive. What it also does is it stops you getting so frustrated because you're taking the information you've got and looking at it objectively rather than being influenced by the result of your trade. At the end of the day, your trade goes where it goes because of what the market does. So don't get frustrated with what your trade does. Look at it from the point of view of, well, I've gained more information now. Whether I've gained some money along with that is neither here nor there. Some days you will, some days you won't. You've then got to say, right, what information have I gained? This way, it won't stop getting frustrated, but it will then be able to put the frustration back in its box. You sort of move on and go and ask yourself, what can you do next? It keeps you looking forward, which to a degree is staying positive, but without this kind of false positivity of, I just screwed that up, but I'm really positive the next trade's going to be great. You can't blag yourself into doing the right thing next time just by thinking you will. You have to create a construct to do that. Opportunities, I've got a slightly different variation of opportunities, and this is a kind of variation of, well, how do you create a playbook? You identify things that happened, where they happened, what happened, and how you could trade those. So opportunities, you do miss, but again, slightly negative. Opportunities on a whole. And the reason for doing that, which I've got here, and I'll send this over, is if you take trade opportunities, one, this helps create a playbook because you break down breakouts, continuations, reversals, event trades, order flow trades, if you've got little scalp, spoofy type trades. But what it also does for you is it highlights how many opportunities you get on a day. Early on in your career, one of the easiest things to do is to think, I need to be active, I need to do something because I might not get another chance. And so you try and push and push and push and find stuff. By doing this, you may note down that maybe there's 10, 12 opportunities on a day. What this will help you with then is the following day, when you've not seen anything 3 hours into the session, you can still go, well, on the basis of the last few days, assuming not a great deal has changed in terms of the general environment, themes, volatility, you're probably still going to get roughly the same number of trades. So it enables you again to move through in a much more reasoned and methodical way than the temptation, which everybody will feel, that when you've done nothing for the first 3 hours, particularly if you're in a trading office and you're aware of other people doing stuff, that you then like, I need to do something, I need to find a trade. You don't want to go hunting. And if you know that consistently over the past few weeks there are 10, 15 trades a day, chances are there still are 10, 15 trades for today. It's just they haven't come up yet. It's like fishing. You have to trust that the fish are there. You can't just assume you're going to get a fish on the first cast. I'm not a fisherman. But you can't assume you're going to get success straight away. And some days you're going to have to wait. Other days, they'll all come straight to you. You don't know. And so by noting these things down, you keep yourself within perspective. You manage your expectations. You're able to then go, right, well, I've seen nothing so far. I know there's opportunities to come. It prevents you from jumping at poor opportunities now and then foregoing potentially much, much better opportunities in the future. Just breaking down, I'm just trying to create a checklist here for you guys. Vary this up. This doesn't have to be the framework, the template to do it. But by doing this, you then just create little situations where you keep in a track of certain pieces of information. I used to grade certain things with a number, as I talked about earlier. I think a number generally doesn't do you a great deal of service. It's not often that truthful. So just really high, medium, low in terms of things that you feel are important, things that you're working on. Again, these are the things that you're going to change and adapt as time goes by. But by keeping a track of your focus, by keeping a track of your commitment on trades, you start to see, again, it helps then with your review at the end of the week where you look back at what you've done. It helps you to then go, okay, these are where my focus is falling, my commitment to trades is falling. And you can start to then align that with other things that are going on. Sloppy trades, track how many there are on the day. And then variations on, where you've made money, lost money. Like I say, write this stuff down to start with. Have a little notepad, write these bits of information down, and then you can give perhaps a slightly more detailed assessment of it, a little bit more structure. This is one of the ways that I kind of discovered for myself at university, that what I would do is have one big notepad for everything, scribble notes down throughout lectures, and then I would go home and back then actually write them up in a much more organised way with diagrams, with detail. One, it makes it easier to look back over in future. But the other thing it does, and if you want to know more about it, read a book called Make It Stick. What it does is by rewording it, it forces you to go back and rethink through what's happened. You understand what's happened much better because you're being forced to recall. If you just write something down once, that's gone. That information is kind of downloaded out, your brain written down, and that's it. If you rewrite it, you then have to take that information back in to rewrite it in more detail. So this then creates a much better understanding of what's happened, why you've done something, how you've done something. So that's why there's a lot of value in writing notes down and then rewriting them with slightly more detail, slightly more clarity. It makes you think about what you've written, it makes you think about what you've learnt, and makes you explain it much better. Things to learn from, things you've done well. Again, these things may well be repetitive over time. And if they are becoming repetitive over time, then you need to address these at the weekend and say to yourself, right, what am I going to do about these? What action am I going to take to make sure that I am committing more size on an initial trade? Don't scale down and then not scale back up. How are you going to do that? What's going to be the new process to do it? It's about creating questions for yourself to answer as you review these debriefs. The final thing that I bring into any debrief is what I call a list of tilts. Tiltometer, as some people might want to call it. Now, don't take my variation of this. Work on your own ones. But you will probably find there are some similarities here. Things like boredom trades. That's something that I know historically I've been quite bad for. Trades where I've sat there and thought, I've done nothing for a while. Better do some trading. And that's not a reason to trade. That's just a case of an itchy finger, feeling like you want to do something. You feel like you want to try and make some money. But if there's nothing to do, you can't take trades on. Chasing after missing trades. This is something that I have found solutions to. Structured solutions. As soon as I feel that temptation to chase, one of the things that I will do is look for a reversal. Look for the opposite trade. It prevents the need to chase. What it also does is means if you do get that opportunity, you're ready to play it. If you don't, that's fine. The goal of it is not necessarily to play the reversal. It is more to prevent myself looking to chase a move. Overtrading after a move. This is a classic example of where somebody might try and extract more out of something. Where you've taken a trade, and I'm sure you would have all felt this. You take a trade, it works out, the move keeps going, and you feel, I should have done this, I should have held on, I should have put more size on, should have. And what people then do is effectively try and get themselves paid on that trade by overtrading afterwards. The move's happened, the action's gone, but it's a really easy time to then go and chase that and look for more on it. That's where you get problems. That's something that I know is a trap for myself. And so then, again, I have to come back to the idea of this is what I was looking for. This is the trade I thought it would be. And that's what it was. How I took that trade on, how I exited it, is what I was looking for. If the move keeps on going, that's not what I was after. And so I can't then keep trying to trade for something that is not there. It's easy to do. It's easy to get sucked into that trap. But if you recognize the fact that you do it, then you're much quicker to recognize situations in which it happens and be able to identify times where you will stop doing it. Next up, we're going to go and look at a weekend review, a weekly review, whenever you want to do these things. How to bring all of this together, all this sort of information gathering, and turn it into something creative, something that's going to generate new ideas, something that you can push forward in time.